Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello, my name is Lukasz from Fidelity, and I'm pleased to be joined today by Matt Jones, our portfolio manager for our systematic equity strategies. Welcome, Matt.
Good morning. Good to be here.
And let's kick off. And I always like sort of getting a bit of a background on people. And you've been with Fidelity for 20 years, which is a long time. And in that time, you've been running a variety of systematic strategies, which is quite unique given Fidelity is very much known as a fundamental equity shop. Tell us a little bit about that journey. How did you get into Fidelity, and what are some of the things you've done over that 20 years? Because that's a long time to be with a business.
Yeah, it is a long time, and it's nice to talk about because systematic equities and what I do at Fidelity for 20 years hasn't really changed. So we have been doing it for just over 20 years at Fidelity, probably about 22 years in total. It has been a long journey. I mean, obviously the early days started off here in Sydney in a fundamental equity team like Bankers Trust in international equities there. So essentially as a quant within a fundamental research team. So a lot of learnings began, I guess, in those early days of portfolio construction and trying to capture alpha from a fundamental research team. And then that kind of took me to JP Morgan for about 18 months to 2 years. And then finally on to Fidelity about 20 years ago in London. So I spent the first kind of 13, 14 years in London and 6 now back in my hometown, Sydney.
Yeah, wow. And the systematic business has grown from strength to strength. I think it's roughly around $22 billion US at the moment, which is incredible. And it's sort of testament to the growth, I guess, in interest in systematic strategies more broadly.
Yeah, and I think the increase in growth, especially more recently, is more around things like customization, repeatability, a bit of a stronger process around risk controls and portfolio construction, which you didn't see a lot more in the early days. It was all about a lot of things were about taking big bets everywhere and big risks and tail risks. And more, I guess, more recently over the last kind of even 5 to 10 years, some of those tail risks have been so big that people are actually starting to kind of open their eyes to something a bit more risk controlled, a bit more disciplined, a bit more repeatable. Yeah,
I mean, we're definitely hearing that from a lot of clients, that they are looking for strategies that, to your point, there's transparency. It's very clear as to the investment process and outcomes, I guess, a bit more known.
A bit more stable and persistent. I kind of try to say, systematic equities and especially the way we do it at Fidelity is like that blue chip stock that you, back in the day, you could buy, lock in your bottom drawer, pull out 20 years later and it hasn't blown up and it's still ticking along.
Yeah. Maybe if we sort of even go back a little bit and if you think about systematic investing, it's a very broad term. So, in my mind, when I think of systematic, it can range from, a very sort of, I'd say, quantitative black box model through to an approach which integrates fundamental research, such as our process, I guess, to a degree. How would you sort of describe systematic investing and in terms of your role in Fidelity, how do we position systematic investing in
and
the
I think
market?
that's the difficult bit. Systematic is like quant in a way. It can be very broad and diverse in the way it's implemented and the different approaches they use. Like you just said, it can be very high frequency black box algorithmic trading like some of the big hedge funds of the world, to the other end of the spectrum, which I think is where we sit at Fidelity, where it's using systematic processes, strong portfolio construction, but the pure input into our process is a fundamental analyst writing a research note, essentially. It's very much forward-looking compared to, I guess, a lot more quantitative strategies, which are looking at a bit more backward-looking data.
Yeah. And it's an interesting point because the forward-looking bit is certainly a critical element, because if you sort of cast your mind back to, say, 2008 and the global financial crisis, and in that period, we did see some pure, what I'd call quant strategies, when you had that big market dislocation really come unstuck. But, if you had that fundamental insight, it gives you a bit more sort of, I guess, pragmatism as well to the process.
Yeah, and we saw that because in running strategies and even long, short strategies and working in Europe during the financial crisis, one of the biggest events I've seen in my career, and hopefully we'll never see again, you do learn a lot of things from that. And it was really nice to see running a more systematic process, a bit more quantitative, but using the deep fundamental inputs, we actually navigated that better than our quantitative peers at the time.
Yeah, wow.
Because we weren't chasing kind of rapidly dislocating risk models. We weren't chasing momentum. We kind of held on to that long-term view. And that has very much worked again too recently in the last 2 to 3 years with macro shocks from Trump, trade wars. I'm not seeing the rotations and the volatility that some more of our quantitative peers in the way we implement our process here.
So maybe give a bit of insight as to how do you marry those two elements, the more, I guess, systematic quantitative element with the fundamental. How do those two things interact from a practical everyday perspective?
Yeah, it's quite neat and it's quite simple. And I think we're very lucky here at Fidelity because, Fidelity International has been around since 1969. Our big kind of parent company, Fidelity FMR Boston's been around a lot longer. So we've got this long, deep history of analysts writing research notes, doing the deep fundamental research. And that kind of buy versus strong buy or sell or strong sell rating comes back as a number. And then straight away we can start to quantify that and build it into a process. And speaking of that history, it's not just recent. So we've got 30, 40 years of this history of research notes. So we can kind of capture that long-term history, analyze it, see when it works best, and work out how to incorporate it in portfolios. So it is really as simple in our process as an analyst goes out there, researchers Commonwealth Bank or ANZ or BHP, and they're speaking to all the analysts around the world globally. They come up with a simple buy to sell rating. That turns into a number. We capture that in our portfolio construction and investment process to make sure we focus on, what we call the higher conviction names, the names they love the most, essentially. We can look at things like their model portfolios to narrow it down to 2 or 3 names they might really like in their sector. And that's where we just take those numbers simply and put it into a filtering process to focus on what are the best ideas at Fidelity and then wrap that in a really strong portfolio construction. And when I talk about, I guess, portfolio construction, it sounds, technical and a bit scary at times, but it's not. It's just building a portfolio in our respect that doesn't have any big bets, like I was saying before. Like, I'm not a value manager in our process. I'm not a growth manager. I'm a Fidelity, active alpha stock picking manager. That's what we focus on.
So the way I could sort of maybe describe it is a fundamental research process and then a more systematic portfolio construction process, which really takes away some of those biases that sometimes you can get, consciously or unconsciously as a portfolio constructor.
Yeah, exactly. And it's more about the unconscious ones a lot of the times. We say we want to make sure there's no unintended biases in our portfolio. So what that means is we want to make sure that we're only betting purely on our stock picking capabilities at Fidelity. We don't want to see anything else creep in, like a value bet or a growth bet or a large cap bet or a small cap bet. We just want to purely focus on that stock picking risk because we're a stock picking house. And that way you kind of minimize any other big risks and big rotations or big kind of dislocations in your portfolio.
And then given you've been doing this for 20 years plus in terms of your career, I mean, particularly on the fundamental research side, I'd be interested to get your thoughts on what, apart from obviously the analyst ratings, which gives you a sense of conviction and quality. What over that 20 years, what are some other interesting observations that, signals that you think have been interesting in terms of when you look at those analyst scores that are quite sort of, I guess, give you a bit of sense in terms of how you then, the direction in terms of weightings in portfolios and so forth.
And again, I think the beauty of our strategy and the beauty of Fidelity, everything that comes down to the fundamental rating, it's quite simple. It's quite transparent. It's not over-engineered in any way. So obviously an analyst has a stock on a buy or a sell rating. What's really important is the change between those ratings. If an analyst goes from a buy to a sell, for example, or a sell to a buy, that's probably one of the strongest signals at Fidelity to either get in or out of that name or increase or even just simply reduce your bets in that name. It's a very strong signal, but of course it doesn't fire often because our analysts take a 3 to 5 year view. So this isn't changing every day. And that's probably one of the most important signals at Fidelity. In my career of looking at things in a more quantitative sense at Fidelity, I think the biggest thing we can do, and obviously the fundamental team do this exceptionally well as well, is reading the research note. So a number doesn't capture everything.
Yeah.
When you read the research note and you get a feeling from the analyst how much conviction is behind this name, whether there's something you need to reach out to them to challenge them on, just to make sure that you have their best ideas in the fund. I think that's a very critical, important step on top of this process that we run that a lot of quant funds or purely systematic processes don't do. And that's really good to understand in the world now. You think of things like AI.
Yeah.
And AI is like natural language processing. What does that mean? It reads the words and it tells you what it thinks is going on. And we actually do that on a lot of our research notes too, to help speed things up. And it is really important to get that conviction behind the research note, not just what the number says on the page.
Yeah, absolutely. And just touching on your comment around AI, interested in terms of your thoughts on, obviously, in terms of your model and the process. It's not static; it evolves over time, I guess. And AI is a good example where it's very much at the center of a lot of conversations across industries, and certainly also relevant in terms of our own industry. How, practically, I mean, obviously you mentioned that you're starting to sort of incorporate some of those things in terms of some of the text. I mean, if you were sort of to think ahead, where do you think it may go in terms of working alongside, what you do from a day-to-day perspective? How does AI
I think the key word is exactly what you just said then, alongside.
Yeah.
I think working alongside AI is where you'll see the most critical and incremental improvements and efficiencies in everything that we do, especially in the research team. I'm a believer, so I don't think AI. I don't believe AI will take over a really great quality research team. Will AI take over an average research house? Yeah, easy. But I think it's the next step beyond that is where you add the incremental value that AI won't be able to achieve.
Yeah.
And like all quant models and all AI, they're not 100% accurate. So it's what you want is to improve on that accuracy.
Yeah.
And that's where the human being, that's where the analyst will step in.
Yeah.
And, the AI will take up a lot of the grunt work. An analyst picks up a new sector instead of taking 3 months to come up on speed on the sector. AI can help them come up to speed on the sector in a matter of a month or two.
Yeah.
Which means they're then adding the value on top of that a lot quicker.
Yeah.
So I think that's where it'll be most critical. And that's where we'll use it a lot more in part of our process as well.
Yeah. I think it's an interesting point because, there's a lot of noise around AI, but I think the point you made around having that quality, and if you've got an edge, whether it's obviously in investments or whichever field, I guess, that's still going to be of high value. And certainly from a Fidelity perspective, that research pedigree is certainly
and the history of the research, and that is 100% is our edge. It's everyone, it's quite commonly aware and known that the critical bit on the AI is the data that you're feeding into it. And if you've got the data that no one else has, which we essentially do, arguably the best research house in the world, with that history of research data, if no one else can get access to that, which is what a quant loves, access to data that no one else can have access to, and we can build models off that to help the research team perform even better, then it's a no-brainer. It's a win-win situation.
Yeah, absolutely. And you're based in Sydney, Australia.
Yes.
Obviously part of a global organisation, collaborating with, our teams around the world. How does that practically work as well, from your perspective?
Well, it's quite interesting. Going back to my early career and studying in the industry, I think 1998 or something, at Bankers Trust across there in Chifley Tower, in an international equity team run under Bankers Trust New York, globally outside of Sydney. So to me, it's not unique and this is quite easy, but it's what's interesting over the many years is seeing how much more efficient it's become.
Yeah.
So I think back to, say, watching the analysts in the old kind of days, picking up the phone, trying to get contact with CEOs across the rest of the world. From Fidelity, that's incredibly easier.
Yeah.
We've got a presence in most countries. Yeah. Infrastructure and technology has evolved, even in my 20 years at Fidelity, infinitely, where, I can put trades down on the desk, share them with my colleagues in London. We can see the impact immediately on all the funds we run. And then you can send trades from anywhere in the world.
Yeah.
dare I say, I have sent trades from Mexico even back in my early days in London. So if I could do it back then, Sydney's an easy place to do global from.
No, absolutely. I could imagine 20 years ago and beyond would have been very different.
Yeah.
Sending the pigeons to carry messages, I think. So.
A bit of Morse code.
Yeah.
I'm not that old.
Absolutely. And you are obviously, from a global perspective, you manage a range of different strategies for different client bases. Obviously, within the Australian market, we are running a systematic strategy in the Australian market. So I think one of the interesting things with that is that with a systematic approach, it's very malleable in terms of whether you're running a long-only equity strategy, whether it's a long-short market-neutral strategy. It's actually very, you can adapt it for different types of strategies.
Yeah, and that's 100% it. I guess other than the renewed focus on portfolio construction, a bit more discipline around how you build portfolios and risk, always one of the biggest selling points, clearly, like you said, is that adaptation to solve clients' problems and solutions. Do you want to exclude certain sectors? Fine. I don't have a sector view, or we could if client wants that, we can incorporate in. But it's very much solving a client problem. And what do you want an exposure to? And we can give you an exposure to that, whether it be indexed enhanced like the SMAs, or full geared long short market neutral funds, bit higher alpha, higher risk.
Yeah,
it's from infinite between those kind of two spectrums.
Yes, the scalability of the process is quite amazing in the systematic approach. So that was been fascinating. It feels like it's the era of the systematic investment style at the moment. So thank you very much for joining us. And that's been fascinating. Thank you.
Cheers. Thank you.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favorite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Fill Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.